President-elect Donald Trump's tariffs and the Chinese government's underwhelming stimulus plans are two of the major global economic events this week. And then locally, the September wage price index and the October unemployment numbers, they'll be released later in the week. Joining me now is Jarden Chief Economist Micaela Fuchila. Micaela, thanks for your time.
Thank you for having me.
Look, let's start with the local economic news. Wage numbers coming out on Wednesday. What are you expecting to see in regards to wage growth?
Look, this is only data for Q3, so by the time we get the release, it's a little bit outdated. I think the RBA and us will be happy to see some easing of wages pressure, which have kept core inflation higher for longer. For the forecast itself, we're expecting a 0.9% rise in quarter-on-quarter measures, which would see the annual rate of growth easing to 3.7%. In saying this, of course, the minimum wage increase earlier in the year was put in place from July 1st, so it could boost a little bit further that way. But any news that wages pressures are easing are quite welcome in this very strong inflation environment.
Yeah, wage pressures easing, obviously good for the Reserve Bank. How big a challenge, though, for employers is trying to fix or boost productivity? Because that's been a real problem that they've seen really for the last few years.
Yes, and the RBA was questioned on this topic earlier last week in the press conference. So what we see is two different stories, right? The wages price index is showing that these measures are easing and there's less inflation, but at the same time, the unit level costs remain really elevated. It has come down, but it's not really back to levels that are comfortable with inflation returning to target.
All right, then a day later on Thursday, the unemployment numbers come out for October, a little bit more up-to-date and relevant than the wage price numbers.
Yes.
But the unemployment rate's been pretty strong this year at 4.1%. It might have been a little bit of a surprise last month, staying flat. What are you expecting this time? We
also expect it to remain flat. It's been actually flat for the last 6 months on average. So 4.1 is quite low relative to history, but it's also coming up from 3.5%. So there is some signs that the labour market is slowing, although we have had positive employment growth. And particularly over the last 6 months, what we've seen is a strong growth from full-time jobs. And this has been driven by the public sector. So it's not a genuine increase in demand and the labour market being extremely strong, but it's still solid and employment growth is always welcome.
Where do you think the unemployment rate will naturally eventually end up?
Our forecast is for the unemployment rate to rise towards the 4.5 level. In saying that, that's consistent with our a measure of neutral unemployment, which is generally lower than what we used to see in previous cycles, around 5%. So it's still really a good outlook.
You mentioned the Reserve Bank. They obviously held their cash rate decision last week. They've got one more meeting this year in December. What would it take for them to potentially cut rates in December? What would they need to see in the numbers this week? Would it be possible or not?
I think it's very, very unlikely. We actually don't see a cut until May next year, sadly. But what we think they're waiting to see is firstly, more information on inflation, just making sure inflation is actually returning back to that level that they see sustainable, which is around the 2.5%. All the decrease in inflation that we have seen so far is to do more with policy measures such as subsidies and things artificially lowering inflation at the headline level. But at the core level, we still have 3.5%, which is a little bit high and uncomfortable for them. So on one side, they want to see confidence on that inflation's returning to target. On the other hand, is the labour market. If the labour market weakens at a faster pace than they expect, then potentially. We also have another GDP report before this December meeting. We think it's very, very unlikely they'll cut in December, but who knows, if the market really weakens very quickly, we might see some movement.
What sort of an X factor is the new president-elect in America, Donald Trump, and he's talked tough on global trade, introducing tariffs on lots of goods going into the States. What might that mean for the global economy and for inflation in America?
Yeah, so it's interesting, right? Because it's not the first time we had Trump as a president. This is a lot less uncertainty this time around on what could he possibly do. Of course, the trade tariffs have been the main headline, around 20% on Canadian goods could come to Australia. Australia is particularly vulnerable to both, right? Weakness in China and the US potentially growing at a stronger pace given all the stimulus that he's talking about and all these tariffs. If we are in the middle of those with very close ties with the US, remember, it's our main foreign investor in Australia, and at the same time we are China is our main trading partner. So the combination of both would probably be responsive to a lot of uncertainty in Australia in general. But for the US overall, the expectation for markets is that economic growth might be stronger if he does deliver on those policies that he's talking about, and potentially supporting businesses through tax cuts and very supportive for the corporate sector.
You mentioned China. How tough a time are they having right now economically?
Very tough. We had last week, the Congress met. They came up with some stimulus around refinancing debt to the local governments. That was actually quite underwhelming. Had some implications, as you said earlier, on markets. The economy is growing at a slower pace than they potentially would like. Of course, Trump being re-elected is not good for them. In saying that, the economy is still holding up relatively well. A lot of
Thanks, Micaela. We're out of time. Thank you.